Welcome to our High Rock monthly video for October. I'm Scott Tomlinson, and with me on the call today is Paul Tepsich, and I am coming to you live from Hawaii. So it's a bit of a time difference. Anyway, let's get started here. Let's talk about September. September for stocks was the worst month since March of 2020. We all remember what happened March of 2020. So there's not a lot of good stuff to report. Volatility increased, so we saw higher levels of volatility, and as a result, we saw financial markets, for the most part, losing ground, except for a few things. Maybe slightly saving our balanced portfolios. Our position in gold, silver, bonds were relatively neutral. But global equities were led by U.S. equities were down in the vicinity of 9 to 10% over the course of the month. That pulled balanced portfolios by the balanced index that we follow as a benchmark down by about 4%. So that was a pretty difficult month. Paul, do you have any comments?
Yeah, and I think, a lot of that, as you can see by this chart, really happened in the last 5 to 8 trading days of the month. And the floor just sort of fell out from the U.S. equity and global equity markets. And we'll talk about it, I'm sure, as we go through the deck. But it really just, the story continues to be one that we are in a period of stagflation, which means we've got increasing inflation and a decreasing global economy with regards to output or GDP. So not a pleasant economic situation for the globe. And it's all being driven largely by the US Federal Reserve being very aggressive to fight this inflation, jacking up nominal interest rates, and that is affecting the US dollar in a big way. So the US dollar is at 20-odd year highs, and most of the things we're looking at here are priced in US dollars. And that means
and then that brings up a good point. We do own assets in US dollar terms, and that does help mitigate the downside to a degree in some of our portfolios. As the US dollar does improve in value relative to the Canadian dollar. And that is a good defensive tactic that we've always utilized and works for us in trying to prevent clients from seeing significantly greater losses in their portfolios.
Yeah, we call that a passive hedge.
Exactly. And just a little bit of a view over the course of the year to date. We just finished the third quarter, so we do want to look a little bit at what's been going on. And of course, it's just a continuation all year long of lower equity market prices, lower everything financial prices for the most part. Paul, we'll talk a little bit about our high yield mandate and how that impacts our tactical model a little bit, and how that has been working to also help mitigate some of the downside to client portfolios. But you'll notice here that basically the balanced portfolio that we follow as a benchmark is down close to 17% in price. Now, that's mitigated a little bit in the total return year to date by virtue of production from interest and dividends. So the iShares Core Balanced ETF is down about 15, just a little under 15.5% on a year-to-date basis as a total return. And that's something you can look at to compare your portfolios against. And most of our clients who have tactically balanced portfolios will find they're down considerably less in their portfolios. Paul, do you want to add a little bit about the high yield and just how it's been functioning as over the course of the last month, maybe?
Sorry, Scott. Yeah, I'll just speak very briefly on our high yield mandate. They are just in general, just the lower side of break even for year to date. They were up on the year, and just after the month of September just down a snick on the year. Why is that? A few reasons. Number one, we are sitting on roughly 15% cash. Number two, we've had roughly a 33% exposure to energy, not just oil and gas exploration and production companies, but energy service companies that service the oil field sector. We and a couple that are couple positions as well that are non-energy related that have held in extremely well. So that's, you know, we've largely for the past 2.5 going on 3 years had a fossil fuel energy theme that has played out pretty well, certainly in these bonds. Now in our private client division, in our balanced mandates and our tactical model, we have taken some energy exposure both through some equity and some fixed income or high yield bond risk. We consider those high yield bonds in the tactical portfolio as equity risk, i.e., we err on the side of considering them more volatile, more like equity than like a corporate bond. But regardless, that they've performed, as I just mentioned in the high yield mandate, they performed the same in the balanced mandate. They've done very well. They've held in extremely well. And I could go on and on about their balance sheets and how great a shape they are in and free cash flow, et cetera. But people fill up their cars. Most people fill up their cars and have to heat their homes. And you understand how expensive natural gas and oil have become. And we are trying to not only gain from that, but in the past 9 months, try to limit losses in our overall portfolio by having exposure to this sector.
Excellent, excellent. Thank you, Paul. That's a good and relatively concise accounting. As everybody knows, we are in this for the long term. We do think that what we saw in the 10 years leading up to 2021 was probably higher returns than what we expect to see in the next 10 years. And that's something that we have to keep in mind. And it's one of the reasons that we think that it's important to have that tactical strategy. The passive, the days of the passive, everything's just going up for 10 years. Those days are behind us. And now we have to be a little bit more proactive and a little bit more tactical. And that's certainly what we're trying to do inside our portfolios as we look into the future and all of our clients' long-term goals. Paul, you mentioned interest rates are higher. Well, that's basically on the back of inflation spikes, which were kicked off by supply chain issues in the economy post-pandemic. And that inflation appears to be spiking. I don't know if you want to talk to that at all a little bit.
Yeah, I mean, the chart certainly looks like it's peaking. I actually think it is. Scott, I don't know if we don't have like a chart of real interest rates at all, or?
Yeah, we do. I have a tips chart just after this one.
Oh, okay.
So,
well, let's maybe move to that. Everybody can see that, you know, there is a potential inflation has peaked. And these are real interest rates. Oh, sorry, those were nominal interest rates you had in. Here's real interest rates. And this is in price, unfortunately, but I think the 10-year, well,
what we're looking at is about a 5-year tips.
Treasury. And in price. So, yeah, I mean, we can just look at this in price and just see how dramatically over the past year, real interest rates, the tips are an inflation adjusted US Treasury bond. So they incorporate the inflation expectations 5 years forward. And you can see how dramatically they've been hit, you know, from roughly 140 down to 110. So it's pretty substantial. So right now, looking at, if we looked at it in yield and we looked at it across the last 10 to 15 years, we would see that the real yield is extremely cheap. So what that's telling us effectively is that nominal yields, maybe we could go back one chart, Scott, that shows just nominal interest rates. Oh, that's just overnight, but okay, we'll go back to the tips. That 5-year or 10-year Government of Canada or U.S. Treasury bond yields have gone up so dramatically in such a short period of time that the market actually, the inflation market, looking at it 5 years forward, is nowhere near as dramatic as that inflation chart shows. So, for instance, the current 5-year inflation 5 years in the future is only trading at around 2.28%. So right now we're sitting here with inflation. What was the inflation chart, Scott? If we go back to, I think it was up. Oh yeah, 8. So 7 or 8%. Call it 8% in the U.S. Right now, the market itself, the government bond market, is looking at inflation, saying, "Nah, it's only going to be around 2.25% within 5 years' time." So something's got to give here. Either nominal interest rates go down, or that tips market is going to keep going. But I think inflation has peaked. I think that the Fed now will slow down its ascent. We saw the Royal Bank of Australia only hiked 25 basis points. I can't remember, Scott, was that late last week or Monday?
Yeah.
Late last week, yeah. And the Bank of New Zealand only went 50. They were talking about going 75 basis points, but I think the Fed and the bank, for sure the bank will moderate their increases, and I think they go in again in early November, but that's right at the midterms, and I think they may pause. I think they may blink. I think pretty much every, and you can tell me, Scott, but I think pretty much every economic indicator we look at shows the economy is slowing dramatically.
Yeah, it is. And the one thing I'll talk about briefly as we talk a little bit about our global equity strategy is that we're seeing significant downward revisions to forward-looking earnings. And that is on the back of expectations of a much weaker outlook for the economy. So, and as we know, earnings ultimately drive stock prices over time. We know in shorter periods of time, interest rates may drive stock prices, but over longer periods of time, corporate earnings are going to drive what fundamentally drives stock prices. And we can see stock prices for the first time in quite a long time are actually now below that forward earnings outlook. And you can see way over on the far right that earnings have started to have flattened and are starting to turn lower. Stock prices are doing so in advance of these expectations. We'll be looking for opportunities. We have been defensive with continuing to hold cash positions in cash equivalents that are now earning reasonable returns, just sitting there, which is not a bad thing. But we do want to get that money being put to work. And as stock prices come down, we will be and you can expect us to be putting some of that money to work into our global equity model.
That's a really good point, Scott, that at the end of the day, what drives stock prices is cash flow. So, if companies are going to start earning less, then the market will continue to reflect that in the price of the equity markets, whatever market it's in. Good points.
Yep. Okay, thank you. Feel free to add to the tactical, but you did talk about
yeah. Yeah, I did, but maybe just one specific, across the month of September, and it actually just came through early this morning officially, but our equity position in the tactical model on Yellow Pages, the old Yellow Pages, Yellow Media, which we've owned for a long time, and those that have been with us for about 7 years have owned various bonds that have all been totally bought back by the company through free cash flow. And now they had so much free cash flow built up, they bought back a third of their equity in a what's called a substantial issuer bid. It actually had to go through the courts because it was so large. And then they also pre-funded a large portion of their pension deficit. So quite a spectacular use of capital. So we had no choice. We were going to be taken out of our stock. I think it was a 98% vote in favor of, but 75% of the large equity holders in Yellow Media okayed it anyway. So I think it wasn't a big premium. It wasn't a premium at all, to be honest. The stock that we sold to the company, which should go through over the next couple of days. But the stock that we have outstanding, I think, is going to be worth a lot more. So I still like that position. It's unfortunate we're selling a third of our stock at the market, not at a premium such as Life. That was about it. Any real changes in the tactical model, Scott? That's it.
And in fixed income, anything to?
Yeah, we had two things I would add. Number one, we added to our position in a 5-year TransCanada pipeline bond. That's an investment grade corporate bond. It had weakened up pretty substantially over the past few months. So we only had about half of what our model weight was. So we bought the other half. So I was pretty pleased with that. And the other one that kind of happened in late August, but it just, I think we just got paid in September, is our position in Rogers Communications investment grade bond, again in the fixed income model, along with the TRAP or TransCanada Pipeline, is they paid us a consent fee. They're in the process of trying to acquire Shaw Communications in Alberta. And the regulators are giving them a bit of a hard time. The bond we own, kind of complicated, but it has special mandatory redemptions, i.e. if the acquisition of Shaw did not go through by December 31st, 2022, the company would have had to take us out of our bonds at a price of 101. And the bonds were trading around 93, 94 cents on the dollar. So in the meantime, we were picking up some very good accrued interest on the bond, and we thought we'd be taken out at 101. However, Rogers came back. They asked for all holders to vote in favor of a consent to allow them to continue not take the bonds out. The bonds would stay outstanding beyond December 31st, 2022. If they don't get this acquisition complete by then. So to allow them to do so, the note holders were given $3.65 of a consent fee they paid to us. That was paid now. And then if it doesn't close by December 31st, 2022, we will get another roughly $1.80 in a consent fee. So, in total, just over $5 odd. So not a bad outcome at all. And we like the credit. We owned it before. We sold that bond to buy this one. So it's been pretty good so far. I'm pleased with it. And those were the only two real additions to fixed income, or only two changes, if you will.
Tremendous. Well, all very positive stuff for our balanced mandates, and great work, Paul. Thank you. As always, I want to remind people that we want to do portfolio reviews. You will be getting your third quarter statement, and along with that will be a request from me or Paul for a review, and we want you to please take those seriously. We want to be in touch. We need to get some updates from you and make sure that all the portfolios that we're managing are managing towards the same goals that we began with. So we want to just make sure that that's all updated. Anyway, lastly, I am in Kona, Hawaii tomorrow. Daughter Miranda will compete in the World Championship Ironman event representing Canada and wearing High Rock colors. So if you have a chance to Google the Ironman World Championship, Ren is wearing bib 1051, and you can see see how she's doing, and we'll be busy cheering her on throughout the day for the full, hopefully not much more than 9 hours that it takes. Anyway,
Hey, Scott, is that tomorrow?
That's tomorrow.
Well, why don't you, if you're able, I know you're going to be busy cheering, but if you're able, maybe you should send out an email to our email distribution list, largely clients, and let us know how she did.
Yeah, I will do that. I will be doing that, and by the end of the day, that could be early morning Friday for some folks in Eastern time zones. But anyway,
don't wake us up. But
no, we won't. But we'll keep you posted as to how things turn out. Anyway, thanks for that, and sorry to drag that a little bit, but great to have everybody tuning in. Look forward to at least giving you an update on this and all of your portfolios at the beginning of November. Until then, enjoy.